Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. As an investor, you should be aware of something called factor investing, where people buy into different themes of their investments. The word theme and factor can be used interchangeably, and I'm going to use theme. We'll look at 6 different themes and how they perform in different situations. Each of these themes represents a different approach to stock selection and portfolio construction, playing a unique role in the investment landscape. But the economy goes through cycles with different phases of the business and economic cycle. So first, an economics lesson. First, we have the early phase. This is an acceleration in economic growth with enthusiasm and exuberance, perhaps caused by low interest rates and government stimulus of the economy. Then we have the mid phase, which is still positive but moderating growth. Interest rates have perhaps started to increase to balance the economy. Then we have the late phase, which has the growth rate slowing down to stall speed. The economy has slowed down as spending falls off and unemployment rises, possibly due to some shock to the economy or macro events. And then the last phase is the recession, where growth contracts as the shock or slowdown has worked its way through the system. Unemployment is high or rising, and the gross domestic product is not increasing. In fact, the GDP growth rate is negative. Central banks are starting to cut interest rates to stimulate the economy. The government is spending more, loosening up lending standards to get more money into the economy, and perhaps cutting taxes to stimulate growth. Once growth re-exerts itself, that's when we go back to the beginning and we enter the early phase. You don't know exactly whether a phase is concluded until after you are out of it. We are currently arguably in the late phase, trying to avoid a recession and go back to the early phase. Different businesses and investing themes perform better in different phases of the economy, and some perform badly because they are not suited to the phase. This is why I am telling you about the phases of the economy when I'm talking about the themes. Note that the themes are not the same thing as market sectors. The 11 sectors in stocks are information technology, healthcare, financials, consumer discretionary, communication services, industrials, consumer staples, energy, utilities, real estate, and materials. The 6 themes are different. So the 6 themes we're going to be looking at are value, and value is a portfolio of stocks with low share prices relative to each company's fundamental value. These portfolios have outperformed relative to the broad equity market over the long run. Momentum investments is growth investing, where stocks with strong recent performance have tended to outperform over subsequent short-term periods. Size uses studies that found a return premium existed for investing in smaller cap stocks. This could be due to the inherently riskier nature. Smaller companies are typically more volatile and have higher risk of bankruptcy, and investors expect to be compensated for taking on that additional level of risk, so small caps will also go up a lot if they are doing well. Dividend yield theme is based on the concept that securities with higher yields have provided superior returns over time. In essence, this is the return investors expect to receive simply from the passage of time based on the yield earned. Quality is investing for higher profitability, more stable income and cash flows, and a lack of excessive leverage. And lastly, low volatility investment attempts to capture a significant share of stock market performance while avoiding the sharpest market highs and lows. This allows investors to maintain exposure to equities with the potential for improving risk-adjusted returns. So let's look now by phase, what does well, outperforming, and what does poorly, underperforming. In the early phase, we're going to have 2 themes outperforming. Value, because anything that is inexpensive will do very well as the economy accelerates and will go up in price. And size, because small companies will flourish in an accelerating economy and outperform, while volatility is to the upside. Looking at neutral for this phase, the dividend yielder, dividend payers are usually large companies, so they will do well, but unlikely they will not do very much since they're just steady performers. Momentum could do well for a time, but unlikely to participate for an extended period in the growth. Quality, much like the dividend payers, these companies are steady Eddie and unlikely to just rocket up. And of course, underperforming in the early cycle, we have low volatility because during the early phase growth, volatility will work for you to the upside, so the low volatility will do poorly. In the mid phase, in the outperforming area, we're going to have momentum because it will do well before the interest rate hikes kick in and may maintain the momentum from the early phase. Value will continue to do well as investors buy low and sell high in a rising market. In the neutral area, we have the dividend yielder, which will continue to pay the dividends and increase a little in share price. Size will continue to grow in the healthy environment, but not as much as in the early phase. Quality stocks will do fine as the economy expands, but nothing amazing, and low volatility will likely do fine along with the quality stocks. Underperforming, none of the themes will really underperform in the mid phase of the economic cycle. Turning to the late phase, we'll have two outperforming, which will be momentum. It'll do well while the economy is still moving, but its time will end as the economy slows. Quality will outperform as the economy slows, but the quality's business continues to be needed, so it will do fine. Neutral will be value. Value will be fine as the stock market performance flattens, but will not drop. Dividend payers will still continue to pay their dividends. Low volatility will save the investor from any downward volatility, but there is not going to be much growth there either. And underperforming will be size. Small caps will do poorly since a slowing economy is not a great environment for startup companies, which are young and vulnerable. And finally, we come to the recession, which is something that people concentrate on and try to protect themselves from. There is a saying that more money has been lost trying to avoid a recession than actually being in a recession. But if you are still trying to manipulate your portfolio, try to look for outperforming themes, which would be quality. It has higher profitability, more stable income and cash flows, and a lack of excessive leverage, making this a safe theme during hard times. Low volatility is going to help by investing in stocks with more stable revenues and earnings, and therefore lower volatility. These stocks may be less susceptible to recessions and other macroeconomic events. Dividend yielders are good during low or not growing earnings because the investor is at least getting, quote, paid to wait. In the neutral category, we have momentum investments, which may not last in their momentum for the duration of the recession if the recession lasts for a year or two. And underperforming, we have small cap companies because they are especially vulnerable during slow and hard economic environments. And value investing is going to suffer because inexpensive investments will likely continue to stay inexpensive and not move very much. Because you don't know what phase of the cycle we are in until after that phase is over, it is difficult to time the getting in and out of different themes. So despite the previous information, you may consider just picking good companies and staying invested, riding out any lows, especially the recessions. You could, however, purchase ETFs that each reflects a theme. So Vanguard, for example, has a complete set of 6 ETFs, and Fidelity has investing themes or factors as well. and therefore make the logistics easy to get in and out of different themes without having to buy and sell multiple stocks. But the timing would still be next to impossible to get right consistently. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.